Hey everyone, welcome back to Corporate Dakota, the place where we tear into what really matters behind those corporate filings. And today we've got I. 3 Verticals Incorporated's latest annual report. That is a whole lot of paper to get through, folks. But don't worry, we will break down the key numbers, the big risks, and what it all means for their business. Alright, before we dive in, make sure you're subscribed right now. We dig through these massive documents so you don't have to. And if you want to keep the conversation going about stock market insights and company deep dives, join our Discord community, linked right down below. Alright, so 3 Verticals Incorporated filed this massive annual report for the year ending September 2025. And after digesting all of it, here is the main story. They are selling off major parts of their business to focus on public sector software. And that is a big strategic shift. And you bet we are going to look at how that impacts their finances and their future outlook. So first off, a huge move in September 2024. They sold off their merchant services business for about $439.5 million. This was a cash deal, and they followed that up in May 2025 by selling their healthcare revenue cycle management business for another $96.3 million. These businesses used to be a big part of their operations, but now they are gone, and the company is making it clear they are focusing exclusively on their public sector software solutions. This sale obviously brings in a lot of cash, but it also means their revenue streams are completely changing. We're talking about a company that used to do payments processing, now shifting purely to software for governments and utilities. Now let's look at the numbers. From continuing operations, revenue increased 11.5% to over $213 million in the year ending September 2025 compared to the previous year. This growth seems healthy on the surface, but nearly $6 million of that came from new acquisitions, and the rest was driven by a modest increase in recurring software revenues and professional services. It is good that they're recurring. Revenue is growing, that is the backbone of a software business, but the overall growth rate isn't exactly setting the world on fire, especially considering they sold off major revenue generating parts of their business. Spending wise, their selling general and administrative expenses went up by 13.8% to over $114 million. That is a pretty big jump, and management says it is because of higher personnel costs and a significant increase in M&A or merger and acquisition related expenses. Now they say they're reimbursed for some of these acquisition costs through transition services agreements, which is an interesting way to manage expenses, but you still have to wonder if all this acquisition activity is truly driving growth or just adding complexity. One area where they definitely saw improvement is interest expense. It plummeted by over 90%, falling to just $2.3 million. This is a huge positive change, and it is primarily because they paid down a lot of their debt after selling those big business units. So less debt means less interest payments, which is always good news for the bottom line. Now about those sold businesses, the financial results for them are reported separately as discontinued operations for the year ending September 2025. These discontinued operations brought in over $20 million in net income, but that is way down from the nearly $191 million they made in the previous year. The big jump in 24 was thanks to the massive gain from selling their merchant service business. So while the ongoing business is showing some growth, the past performance was heavily skewed by these big sales. Let's peek at the balance sheet for a moment. Total assets dropped to about $638 million from over $730 million the year before. This makes sense because they sold off significant portions of their business. Cash and cash equivalents also decreased to about $66 million from $86 million the previous year. However, their goodwill, a measure of the excess purchase price they paid for AC, acquisitions increased slightly to nearly $248 million from $242 million. This large amount of goodwill suggests they have relied heavily on acquisitions for growth, and it also carries potential risk if those acquisitions don't pan out as expected. On the liability side, total liabilities are down significantly to $120 million from $215 million. That big drop is largely due to paying down debt after those business sales. So that is a good sign for their financial health, but their stockholders' equity is up to over $517 million, which is a positive trend, especially considering share buybacks. Speaking of share buybacks, they repurchased over 1.5 million shares of their class, a common stock, for about $38 million during the year ending September 2025. Under a program that ended in August 2025, they also announced a new buyback program for up to $50 million. A lot of companies are doing this right now to return value to shareholders, but it also means they have the cash flow to support these repurchases, which is always a good sign. Now, a quick look at risks. The company is always talking about cybersecurity, and those risks are very real. They say their systems are constantly under attack, and while they have measures in place, there is no guarantee they can prevent a breach or data loss. This is especially critical for a company handling sensitive public sector and financial data. If they do have a major breach, it could lead to massive fines, lawsuit. It and serious damage to their reputation. Imagine losing sensitive citizen data for a government agency. That is a nightmare scenario. They also mentioned the risks associated with the recent sales, including potential liabilities from those deals, and that they are now heavily dependent on the success of their remaining public sector business. That concentration risk is something to watch closely. And of course, they are in a super competitive industry with big players like Tyler Technologies and Constellation Software. They admit many competitors have more money and resources than they do, which means they really need to nail their acquisition and integration strategy to stand out and grow, which can be a tricky balancing act. So what is my take on iVerticals Incorporated based on this filing? Well, they've made a bold move selling off major business lines to simplify and focus specifically on public sector software. While this generates cash and reduces debt, it also puts immense pressure on their remaining software business to perform. Their future success hinges on organic growth through innovation and carefully chosen acquisitions. They've got a lot of goodwill on their books, which is a constant reminder of their acquisition-heavy strategy and the need for those acquisitions to continue paying off their cybersecurity. Risks are ever present, and a major breach could be devastating for a company in this sector. However, their move towards recurring revenue and their stated focus on streamlining government operations represent a clear strategic direction. If they can execute well on this refined strategy and manage those significant risks, they could find a solid groove. But the competition is fierce, and the success of their focused strategy is far from guaranteed. Alright, that is our deep dive into iVerticals Incorporated's latest report. What do you think about their strategic shift and their financial health? Let us know your thoughts in the comments below. If you found this breakdown helpful, please smash that like button and subscribe for more corporate financial analysis. And don't forget to join our Discord community link in the description below to keep the conversation going with us and other viewers. Thanks for watching, and we'll see you in the next decoder.